Welcome back to class. Today we're going to be looking at the McBain family. I think you may recall that I mentioned Bailey McBain, or I believe I referred to her as Bagpipe Bailey. Well, we're going to be using that family, the business, as a case study today as we look at cross-border issues. I think this case would be a good example of why wealth management becomes much more complicated when family has family members, assets, income, business activities spread across more than just one country. In a domestic case, an advisor may only need to think about just one taxing system and one legal system. But when you go across borders, that's no longer enough. And so I think I have this broken down in a manner that we can look at four major areas where an advisor would need to focus when they open up a case and start working with a family in this regard. So in the opening slide, it's going to introduce four major areas for the professional wealth manager to review. The first is income tax and tax residence, which means identifying who is taxed, where they are taxed, and how to possibly reduce the risk of double taxation. The second would be the retirement and the payroll discussion, or the retirement and payroll issues that would need to be looked at, because each country will have different laws regarding their social insurance systems, be they Medicare or Social Security. And so what we need to look at would be each country's program, and also an arrangement that the countries may have with each other called totalization agreements, and how those agreements may help with the more efficient application of those laws. And again, avoiding duplication, perhaps even adding credits where a person may not be entitled to enough credits in one country to have retirement income, maybe being able to stack those with credits they receive from another country. So that would be what the totalization agreements are about. The third area would be estates, the actual property owned by the families, where that property is owned, any gifting ideas the family may have, the inheritance laws of those countries. As you will see as we move into this, the UK has a different taxation system for wealth than the United States. We'll look at some treaties that are available to help reduce the dual impact of estate tax laws as well. And then the fourth would be just mainly how property is to be titled and reported to the various taxing agencies, or not necessarily just taxation, but just reported to different government agencies. And this is where it can get extremely complicated, because countries will have different rules regarding the reports that have to be filed, depending on the type of property that you hold and whether there's income associated with that property. So as we go into the case, keep in mind that the central challenge is not just technical knowledge. This is very complex stuff, but what we're going to do is just keep this in a bite-sized fashion so that you'll know at a very high level the four basic areas that need to be explored, and maybe some examples of why they need to be explored. And hopefully when we walk away from this, not a very long discussion, just about 10 or 12 PowerPoint slides to this deck. Hopefully you'll have a better idea of those cross-border issues that need to be evaluated. Okay, with that, I'm going to pull myself off the camera here so that you can see the entire text from the slides, and we'll move forward. Okay, slide number 2 is basically just a restatement with a little bit more rounding out or elaboration of each of those four sections that we're going to be covering. Moving on to slide 3, I think this is where we can really have more of a detailed discussion. So looking at slide 3, which states cross-border family types, a comparison. This slide gives us 3 common cross-border family profiles, 3 types of families, and shows why the classification of the individuals in the family will matter. So let's take a look at the first one, type 1. Type 1 is basically a foreign national living in the United States. So this would include people on visas, green card holders. The major issue here is that once someone becomes a U.S. tax resident, they may be taxed on worldwide income, and they may also face foreign asset reporting requirements as well. So the planning risk is considered to be high, as you can see, high because families often move first and then they start asking questions later. They want to know, now that they have moved, how should we plan for taxes, or how should we deal with the income laws or the Social Security laws? And a lot of times it's too late to do that when that time comes. And as you can see at the bottom of the slide, Type 1, there are a number of mistakes that are listed here. I just did a quick Google on that just to give an illustration of the types of mistakes that could occur when people actually pull the trigger before they plan ahead. And I won't go through all these and read each one of these, but they are significant. They can be very significant in terms of lost opportunities and significant taxes, major taxes, which may not, in fact, they wouldn't have applied at all if they had planned appropriately a number of these areas. So this is just an example. Take a look at that yellow table at the bottom of the yellow box to give you an idea. Now, type 2 is a U.S. citizen who's living abroad, or in some cases, a green card holder living abroad as well. Now, the main issue here is where you have a citizen-based taxation event. Even when these individuals live outside the United States, a U.S., for example, if you're a U.S. citizen, if you live outside the United States, or if you're a green card holder, which means that you are treated as a resident for tax purposes, even when you're outside the U.S., you may still have filing obligations with the United States. And you may face, in fact, double taxation if you're not planning correctly. So the slide notes that there's a high burden there as well, and a possible exit tax for some people who may actually be renouncing their U.S. Citizenship and moving permanently to another country. There could be some issues affecting them as well, some surprises. And so we'll look at that on a separate slide. We'll look at what those surprises are. Now, type 3 is a foreign national living abroad, but owning U.S. assets. So someone in another country actually has, in the example, our case study, the McBain case, actually holding land in the United States. So in those cases, you could have United States estate tax exposure because there's property, that's U.S. properties on U.S. situated assets. The slide will note that this profile carries a medium planning risk, especially where families are underestimating the fact that there may be transfer taxes associated with property, and they're just transferring that property to someone else. They may not realize that there are estate or otherwise known as transfer tax issues that could arise. So the larger lesson is that cross-border families do not all present the same problem. Before an advisor recommends anything at all, the advisor needs to identify the family type, the planning risks that come along with that when they're considering transferring property. Okay, let's now move on to the next slide where we will introduce the McBain family. And as we see here, this is a younger version of Bailey McBain, or Bagpipe Bailey, that you saw. I guess that was probably back in February or so that I found that little scroll in the rocks and found an image of Bailey. The McBain business story, I think, gives a good example of the types of issues that come into play. So we're going to look at the actual family. Okay, the case is built around a business that's been around for a very long time. It has a very long history and has a very concentrated asset base in Scotland. So McBain Bagpipes was founded in the 1200s, and it's been operating now, well, if you count from more than 800 years, roughly. It's been described as the leading producer of traditional Scottish bagpipes. It holds the global market share of about 35% of all bagpipes sold throughout the world. So this makes this family not just a wealth case, but also a family business continuity case. So we're not only dealing with just how to have efficient management of a company across borders and transfer of property to family members, but we're also talking about a true family legacy that has continued for centuries. And of course, the goal of the family is to continue that legacy. So the slide highlights several key assets here. First of all, there's the operating company in Scotland. And we have valued that for purposes of this discussion at about $70 million. Second, there's a $10 million portfolio of investments, that is stocks, bonds, other securities that are invested throughout the world in different jurisdictions. Third, there's 1,000 acres of timberland, and we've located that timberland to be in Banner Elk, North Carolina. I'm sure some of you are familiar with the Banner Elk area. So kind of keeping with that Highlands tradition, fortunately, this family was able to find the perfect type of wood to be used in their bagpipes, and it is sourced out of the the Highlands area of Carolina, which would be the Banner Elk and Linville area. Now, the company is owned by William and Grace McBain. They are, I'm not sure what generation McBains they would be, but they are the current owners, William and Grace. And the wood is shipped over from North Carolina for production in the factories. We also learn about Flora. Flora is their daughter. So actually, let me back up. William and Grace McBain have one son and one daughter. The Flora is actually living in Banner Elk, North Carolina. And so we're going to look a little bit more deeply into that in just a moment. The important insight on this slide, I guess the most important insight on this slide, is the concentration issue. As you can see, most of the family's value is tied up in a single operating company. That creates a liquidity challenge because if one child is to receive the business, and if the family wants to treat the other child fairly, then the family may need a way to create cash, some liquidity there without having a forced sale of the company. So let's move on now to slide number 5 and take a closer look at the family structure and their inheritance plan. Okay, in this slide, we are mapping out, in some fashion, the family, and the slide shows the planned inheritance structure. So we have William and Grace McBain living in Scotland. They own currently 100% of the manufacturing plant of McBain Woodwinds. They are still active in management, and collectively they hold the company's valued at $70 million. Their daughter, Flora, lives in Banner Elk, as I mentioned. She's a U.S. resident. She manages the timberland for the company. Now, the company actually owns the property in the Banner Elk area, the Linville area. She lives in Banner Elk and works in that area as a part of the business, basically. She's on a salary. Under the estate plan, her salary, by the way, is $150,000. Let's see if that's stated here. Yes, here it is at the bottom. $150,000 salary that she is receiving. She is a U.S. resident living in North Carolina. Under the estate plan, she is set to inherit that timberland at whatever value that is, the 1,000 acres of timberland. And they have also decided to, in terms of liquidity, at least letting her take over that $10 million portfolio of stocks and bonds and other investments. Again, they're spread throughout the world, but those will be going to her as well, since we already know that the vast majority of the business, of the value of the estate is held in that business. So let's talk about that. We have Abel now, the son, Abel McBain, who lives in Scotland, and he serves as the plant manager. And under the estate plan, he is going to be receiving 100% of that $70 million business. But of course, there is this question of equity or equal distribution across the two children, and the parents do want to benefit each child 50-50 when they pass away. So this slide hopefully makes the family's intentions fairly clear. The parents want business continuity, so the operating company is going to go to Abel. It will not be divided up, sold off to other shareholders who could dilute the family interest in that business. They want it all to stay intact. The operating company goes to Abel. They want Flora to receive the timberland and the portfolio. But of course, there's the tension. The business is worth much more than all the other assets combined. So even though they're being divided intentionally, this is not an equal distribution. So we need to look at that imbalance at some point. Again, as the advisor, what your job is at this point is to identify the family members, identify the goals of your client, what they're trying to achieve through this estate work that they're doing. And then we start looking at the different laws that could apply and strategies that could apply to deal with those laws. So let's now move on to the next slide. So the first planning issue that comes up is that income tax. Let's look at the tax issues related to this engagement. And Flora is going to be the focal point here because Flora is the individual who is living in the U.S. She is a U.S. citizen or perhaps green card holder, but for all practical purposes, she is being taxed according to the laws of the United States. And as you will see, the United States taxes certain people on their worldwide income, regardless of where they're earning their salaries. The U.S., if they're living in the U.S., they are taxed on their worldwide income. So, because Flora is a U.S. resident living in North Carolina, she is subject to U.S. taxation on her worldwide income, including that $150,000 that she's receiving from the Scottish company. So, that's going to be relevant for U.S. tax purposes, even though it's coming from a foreign employer. Now, the timberland, if it produced income, then that income, if it's going to her, if she had a side business where she received other income from that timberland, then that would also be U.S. income and subject to U.S. taxation. So if the timberland is only used by the UK company, the Scottish bagpipe company in operations, there could be some difference in the way that that's handled from a tax standpoint. Of course, it depends on the type of the business entity that we have. I would imagine it's a corporation. And as a corporation, the U.S. laws may allow some other form of crediting to take place. There are rules regarding depletion or depletion allowances. And again, we're starting to get deep here, so I'll stop. What we're saying is that there are certain allowances that can be made because the timber is being cut from that land, and there is a depletion of the resource taking place, and so there's an offset that can take place depending on the type of entity that is subject to those U.S. laws. So we'll just leave it at that. We'll just know that Flora is a U.S. resident. She's subject to U.S. taxation on her income. We know that her $150,000 salary is going to be relevant. We'll have to look at it and see how that plays out. So the key problem that we're arriving at here is coordination. Flora has a Scottish salary. She has potentially U.S. timberland-related income. Without any planning, it's possible that more than one country may be seeking some income tax to be paid on the same economic activity, whether it's the salary or maybe some income that she may be receiving with a separate business where she's actually doing some logging or some lumber work on the side as well. So that's why coordination becomes very important with respect to treaties across countries. The United States has a treaty with the UK, as they do with many other countries. And so the slide, as you can see here, introduces the U.S. Treaty arrangement with the UK and the concept of foreign tax credits. So if UK tax is paid on Flora's salary, then a foreign tax credit may also help reduce double taxation that would otherwise occur in the United States, because the UK is going to tax Flora, and it would likely be the United States would also tax her on that global income, except that a treaty steps in the middle here and says, wait a minute, we have some offsets here. And so the slide reminds us that employment income is generally sourced where the services are performed, which means Flora's work really matters greatly. She is in the U.S. She would normally be taxed under the U.S. tax laws, even though that income is coming from a Scottish company. But the treaty steps into play and allows an offset for foreign income taxes that may be paid. So the big lesson from this slide is fairly straightforward. Once a family member lives in one country and earns compensation from another country, then residency has an impact. The treaties between the two countries has a huge impact, and foreign tax credits may or may not be available to them. And all of that needs to be coordinated carefully. So that's the first takeaway, or at least one major takeaway with respect to Flora and her residency and her income. Okay, let's move on to the next slide now. The second category, as mentioned at the beginning of the discussion here, is this payroll, pension, Social Security, the retirement systems that are in place across different countries. This slide emphasizes an important distinction here. When people look at the subject of income taxes or taxation generally, sometimes they confuse or throw into the same bucket for consideration income taxes and payroll taxes and just consider them all to be taxes, but they're not the same. As you know, we've discussed the FICA taxes, the FICA. That's the United States system of collecting As you go through your career, they withhold that 6.2%. Now remember, it's 7.65 total for FICA. The 6.2 is for Social Security. 1.45 is for the Medicare component, which rolls up into that overall FICA tax. So we have that system, the Social Security system, and something I'm not sure that I mentioned earlier in the semester, but it's worth noting now that you have to earn a certain number of credits towards Social Security to actually receive retirement benefits down the road, or disability benefits if you became disabled. So in order to actually receive money back that you've been paying in and that your employer has been paying in, you're going to have a certain number of credits. And basically it's 40 quarters or 10 years, okay? 40 quarters of credit to your account. Other countries will have other ways of crediting service, and they'll have other ways of collecting your contributions. It's probably most likely not going to be the 7.65% FICA or the 6.2% Social Security that we see coming out of our paychecks, but they will typically have some way of pulling from payroll as well. So what we'll find is that across the world, individuals working in those other countries will be paying into a system. So the question then comes up, what about the payroll tax, and how is that handled if someone moves out of that country and they've been building up or accruing benefits in their home country? So let's move forward with this slide. The slide brings in this case, we're sticking to the Scotland, or actually the US-UK totalization agreement does include Scotland, so we'll call it the US-UK totalization agreement. That's what we're referring to when we're talking about looking at the retirement arrangements or the retirement laws of each of these countries. So the totalization agreement between the US and the UK, it basically is designed to prevent dual Social Security coverage, meaning that if you're working in the US and earning a US salary, if you take certain steps and have certain proof, you're able to obtain credit under the US system. And over in the UK, they will not be withholding or charging you some amount going into their program there. Or it could be just the opposite. You could be accruing credits and benefits under the UK system and having withholding over there and not having withholdings on your salaries that you may have in the United States. So in general, it helps make sure that a worker is covered by only one country's system, instead of having to contribute to two different systems on the same earnings. Because remember, as we said before, with Flora's salary, she's taxed in the UK and she's most likely going to be taxed in the US, or would normally be for tax purposes, except for that treaty, which allows the foreign tax credit. But what about payroll taxes? Is there some other treaty or some other document that allows us to not have dual withholdings on her salary? And the answer is yes, there is. That's that totalization agreement, as you can see here, the US-UK totalization agreement. And so basically you have a document called a certificate of coverage. The certificate of coverage is an important document used to show which country's system is going to apply when it comes to accruing retirement benefits and the withholding necessary to accrue that benefit. So for the McBain case, this matters because Flora is working in the United States, paid by a Scottish company. The wealth advisor, assuming you're the wealth advisor, then you would have to separate the income tax question from the payroll tax question and be sure that we understand how her retirement income would be affected depending on, which system she's drawing from. By the way, you can also be withdrawing from two systems. It's possible that over the years you have contributed to both systems and have enough credits in each system, the Scottish system, Scotland, as well as the United States system, to actually have two separate pension incomes. So it's not prohibiting you from having pension income. What it's allowing is for you to not be double taxed, so to speak, on payroll taxes. And also it's a way to allow you to accrue through these totalization agreements, accrue credits. It would be a shame that if you came close to 40 credits in the United States, but because you didn't work over here, your salary was no longer, your payroll was no longer in effect over here, you moved back home to Scotland and the remaining credits were over there and you were just short in the United States. Well, they have a system through the through the totalization agreement to where you can actually move some credits from one country to the other. Again, I'm getting a little bit into the weeds, but as you can see, when we look at cross-border issues, there are many, many questions that come up, and we need to be looking at not just the federal tax laws, but also the inheritance tax laws, the payroll tax laws, the retirement laws, all of these particular laws. Let's move on now to slide number 8. So now we move to issue number 3, and we're now looking at estate, not state, but estate, gift, and inheritance tax planning. This slide makes the point that cross-border families have to coordinate 2 separate transfer tax systems at the same time, or estate tax systems, depending on how you prefer to say that. The U.S. estate tax system, and there's a gift taxing system as well, and the UK inheritance tax system, which applies to England, Scotland, Wales, one other country, Northern Ireland. I think those are all subject to the UK inheritance tax system. So on the United States side, the slide points out, of course, the number that we've already seen before, the $15 million exemption or exclusion amount per person. To restate what we discussed back in the estate chapter, every individual, you, for example, are entitled to a $15 million exemption before the estate tax starts to apply to your estate. So if you were to pass away and had $15 million worth of wealth, that could pass to a third party without being taxed for estate tax purposes. And as we also discussed, that doubles if you have a spouse. So there's a huge exclusion amount that is available for U.S. residents. Now, the UK has an exemption as well, or an exclusion amount. It's called the NIL rate, or the NIL, the NIL rate. And literally, that's what it means, nothing. NIL means nothing. The NIL rate band, and each spouse is entitled to 325 pounds of exemption. So we'll use the British pound. 325,000. So together, that's 325. That is $650,000 of property that can be moved using both of their exemptions combined. There's also a $150,000 residence allowance as well that can be passed by each spouse. So in total, and do not worry about the dollar amounts here that I'm referring to. I'm just giving you an example of a contrast between the US, 15 million, and the UK, which is a total of $1 million of exclusion amount as well. So as you can see, and then that rate, I think, comes in at about 40% after that $1 million exemption is used up. So definitely differences in tax laws there, okay? The slide also reminds us that the UK rules apply across the UK and not in just one country. So some laws apply on a country-by-country basis. The UK law applies to 3 or 4 different countries within that region. Now, the slide also notes that the United States and the United Kingdom, they coordinate estate taxes primarily through, yes, another treaty. So there is an estate and gift tax treaty between the 2 countries. This, just like the income tax treaty that we have, it helps prevent double taxation by the taxing authorities, and it also allows credits to the degree that an estate tax or an inheritance tax, which is basically essentially the same thing. There are some differences, but in the UK they call it inheritance tax, and in the United States they call it an estate tax. There are some credits that are allowed across the countries there, according to that treaty. So the main point here is that the numbers are not the main lesson here. Don't worry about the 15 million and the 325,000 number. The lesson is that the family is operating across 2 totally different systems with completely different thresholds, different taxing concepts, and different exemptions and relief mechanisms. So an advisor who's working with a client needs to understand, what the family's wanting to do, and they then need to be focusing on those transfer tax issues that come into play across the different countries. And just keep this in mind. In a lot of cases, we're not really talking about just 2 countries. There may be 3 or 4 countries involved with their own estate or inheritance tax laws that have to be reviewed. Moving now to the fourth of the four issues, we are going to be looking at property ownership, titling of property, and the reporting piece. And this is where reporting can be absolutely, totally confusing. Do not worry about the names of these filing reports. I'm just giving you these as examples and noting that if the client, if your client or if the person who's affected by this fails to provide these reports, there can be some financial consequences there. So we're talking about property ownership and cross-border reporting. This slide reminds us how an asset is titled and where it is situated can change the planning outcome. So those business interests in Scotland must be owned in a way that protect Abel's operational control of the company. The North Carolina timberland needs to be titled in a way that will allow it, as we discussed earlier, to pass smoothly to Flora because the family wants her to have the North Carolina property. Business interest in Scotland goes to Abel, North Carolina land to Flora. So the $10 million portfolio now, which is basically invested around the world, there can be some estate administration and some tax complications depending on where those accounts are held and how those countries tax those assets and how ownership is actually structured on those assets that are titled in different countries. So the central insight here is that the location and the ownership structure is going to determine which country is going to be taxing that asset. And at the bottom right, I have Flora's potential reporting obligations as a U.S. citizen. Because she's a U.S. resident, she may have to report on her non-U.S. financial accounts through this FBAR reporting, FBAR, that's foreign bank account reporting. That's the law that has anything over $10,000. I think there's some reporting and compliance that has to be taken care of. Also, other financial assets she may receive or may have in ownership of through the FATCA, that's Foreign Account Transaction Compliance Act. If I'm getting that right, I can't recall the exact meaning of the acronym. Also, if she receives gifts or other trust distributions from her parents, if there happen to be a trust out there, other forms that may come into play. So basically what we're getting at here, and again, do not worry about memorizing any of these forms. Just understand that because we have a person who is a U.S. resident and there are foreign business transactions and foreign investments taking place, that we have to look at compliance as a big part of planning to avoid some potentially significant losses of assets over time because of a failure to report if that were to occur. So in this next slide, I'm giving you an example of how the tax picture could change depending on the titling of the property, who actually owns the property. It's expanding on the idea introduced on the previous slide by giving an example of just how the location and that ownership structure can affect the tax results. So in this case, in scenario A, what I have is a UK resident who's buying a New York apartment directly in his or her own name. So because the real estate is physically located in the United States and is held directly by that individual, no corporation, then the United States has the primary taxing authority over that property for estate tax purposes if that person were to pass away, even if the owner is not a U.S. citizen, because that property is in the United States. So in scenario B, we have the same resident, but instead of just purchasing outright from a New York real estate company that property, they set up a British corporation through British Virgin Island, British Virgin Island Corporation, and that corporation then buys the New York real estate. So in that case, the individual is not directly owning the real estate. The individual only owns shares in a foreign corporation, the BVI corporation. And so the BVI owns the apartment. That change alone changes the character of what the owner holds, and it may alter the estate tax result as well. Although other types of taxes could still apply, the reason that this example matters is that it makes sort of an abstract concept more concrete to us. There's a change in where the asset is sitting or a change in the legal wrapper around that asset. If either of those two things occur, it could actually change the fact of which country would actually be taxing that asset. It's exactly why advisors have to pay close attention to both the geography involved where the property is being held and the actual entity that's holding that property in cross-border planning. So now let's move on to a solution for the family, a possible solution. This is basically the heart of the case from a planning standpoint. It's clear this family's objective is clear. They want Able to receive 100% of the operating company so that the business can continue under unified control or family control and keep the family name preserved. Flora, they want her to receive that 1,000 acres in the Linville/Banner Elk area of North Carolina. And they want her to have the stocks and bonds and other investments that are invested throughout the world, another $10 million roughly. The challenge, as we can see here, though, is liquidity. We have the $70 million business, and then we have an unequal share going to the daughter. So if the parents want the two to be treated more equally in economic terms, we have that value gap. So the one proposed solution, is the irrevocable life insurance trust. Now, life insurance trust can be set up so that it's funded by gifts from the parents. It's formed, the trust is formed, set up by the parents, William and his wife's name. What's his wife's name? William and Grace. That's right, William and Grace McBain. They set up the trust, and the trust then purchases a life insurance policy. It could be a second to die policy. There are different types of life insurance policies that are used to fund these types of trusts, but basically the purpose of the trust is to hold a very large life insurance policy, and the McBains, the parents, will make gifts into that trust of part of their property to pay the premium. So they make a gift to the trust, and the trust then purchases the insurance. And there are reasons for that, having to do with trying to keep the proceeds of the life insurance out of their estate. And if they have strings attached, then it's possible that all of that money, the life insurance proceeds, actually could be counted as more estate with respect to taxation. So they're trying to keep that property out of their estate. So they set up this irrevocable life insurance trust. They fund it through gifts. And while I'm not sure that we actually covered this, but you can make annual gifts, and there's an amount you can give each year without it actually impacting you from a tax standpoint. That's $19,000 per year. Per individual. So if it's a spouse involved, so you have 19 plus 19, $38,000 total combined that they could make into this trust. And the trust could then purchase that life insurance policy with that amount of money. And I have no idea how much insurance that would purchase, but that's one way. Then they may have to fund it even more beyond the $19,000 each to pay for the total premium that would provide the level of liquidity needed to balance those estates. So that would be, we just covered just one solution. That would be a possible solution. With, of course, the ultimate point here being that while Able McBain receives the stock in the business at their death, then the daughter Flora will receive this very large life insurance policy, which has, cash, which hopefully that combined with the land and combined with the other investments would help equalize the estates going to the two individuals. By the way, one other thing that can happen when you have a gifting program, say to a life insurance trust, is to the degree that you're making gifts, and especially large gifts, you're actually reducing the size of your estate. So this is a very common planning scenario used by individuals who have an estate tax problem, to have a gifting program throughout their life, and to use trusts like this irrevocable life insurance trust. As long as it's irrevocable and they're making gifts to it, they are removing those gifts, the value of those gifts, from their estate. And so their estate is actually smaller. And then with that entity, that trust, whether it's a life insurance trust or some other type of trust, that is then holding the property to be distributed to their heirs or to other entities. And that has been removed from their estate for estate tax purposes. Now let's move on to the next slide, which is the professional potential action plan. So in this slide, we have the 5-step action plan that an advisor, a wealth management advisor, could follow in a case such as the one that we just introduced. Number one is to, as we said, let's find out who our client is, who are all the parties involved, parents, children, other interested parties. We need to find out where both the people are located and where the assets are located. So different jurisdictions, we need to know where all that property is, including the investments. It means that we're identifying every relevant family member, where each person lives, and the assets in each jurisdiction. Step number two is confirming the tax residence and income. Where would this individual be taxed for income tax purposes, and where would the property be taxed, or how would the property be taxed with respect to where assets are sitting? Step number three is to be sure that we're separating the income tax from the payroll tax issues and those retirement systems. Because remember, and you need to be sure to understand the distinction between these two, income tax and payroll taxes. We're talking about two different things. While income taxes are deducted from your paycheck, when we talk about payroll taxes, what we are referring to is those retirement and other benefits type programs by government, by federal agencies, the Social Security program or the UK pension system. This is critical because Social Security coverage and pension coordination between two different countries can be very different. And there, as I said, totalization agreements, learn that word, totalization agreements, and these crediting allowances that can happen where you could use maybe one country's credits to build up credits in another country to help you in one country or the other if you're trying to build up enough credits to have pension benefits from that particular jurisdiction. Step four is to review that transfer tax or that estate tax system of each country, understand the exposure that the client may have. The advisor needs to look at estate taxation, gift tax, excuse me, I just had some smiley faces pop up on the screen here. There we go. I hit the keyboard. And inheritance tax. So estate, gift, and inheritance tax issues need to be looked at from each jurisdiction, and also looking together at those tax treaties that are available between the countries where there may be some offsets or credit given for estate, gift, or inheritance taxes that are paid in one country. You may have an offset that's available in another country because of an agreement that the two countries have. And then finally, there's this fifth, you might as well call it a step. It's not necessarily an issue, but it is a step of the advisor, and that is to build in some type of a compliance calendar. They call it a reporting calendar in some cases, where the family will understand on the technical side the different types of reporting that have to be followed, and the types of forms that have to be followed, and the authorities that will be receiving those forms. And we discussed those briefly on issue number, I believe it was issue number 4 that we were looking at. So in wrapping this up, we have the final slide which summarizes the entire case. It pulls together the 4 major planning issues that need to be addressed, and it also explains why the McBain family is a fairly decent teaching example, where you have businesses, you have children living in different jurisdictions, you have income that's coming from different jurisdictions. Flora's U.S. residency creates that income tax and residency issues because she works in the U.S. She's connected to a Scottish company. There's a foreign tax credit that may be available to her. There is other treaty coordination that may be important when it comes to estate planning or payroll tax planning. So 3 or 4 different types of laws kind of come into play there just with her situation alone. The estate planning becomes fairly complex because there are 2 different transfer systems, different exemption amounts, 15 million for the US, close to 1 million pounds on the UK side. The irrevocable life insurance trust, a possible solution there because we have an estate that's going to be imbalanced. The daughter is not interested in running the business or having the business, but she does want to have, an equal share of the estate or fairness in the estate. And so this case matters in that it combines several cross-border family profiles in one fact pattern for you to see. And it also shows why, as a wealth management advisor working with a family on international issues, this professional can't look at just tax or payroll or look at investments alone. They can't look at these in silos even. You need to come together, possibly even pulling in the expertise of multiple professionals to look together at all of these issues. Because while a professional may have expertise in one particular area, let's just say estate planning and cross-border estate planning, they may not have the expertise with respect to the income side or the retirement pension programs that are administered by different countries. Okay, that wraps up our discussion of cross-border planning. Please let me know if you have any questions.